Most people think making serious money from the stock market is only for experts or wealthy insiders. They imagine complicated charts, endless research, and risking thousands of dollars they don't have. But the truth is, you don't need a fortune or a finance degree to start making real progress in the stock market. What you need is the right mindset, consistency, and a willingness to learn. I started small, very small, and over time, through consistent action, research, and patience, I've been able to grow a portfolio that generates a 17,000 per week. That didn't happen overnight. It happened because I treated investing as a skill to develop, not as a gamble. Every trade, every investment, and every decision taught me something that compounded into bigger returns. This speech is about giving beginners a clear roadmap. You'll learn how small steps, disciplined routines, smart research, and emotional control can turn your investments into a serious income stream. By the end, you'll understand why consistent effort beats luck and how starting today, even with little money, can put you on the path to financial freedom. When most people think about investing in stocks, they picture huge sums of money, complex strategies, and big risks. That image often stops beginners before they even try. But the truth is, 48, you don't need a fortune to start. You don't need perfect timing. You only need the willingness to begin, even if it's with a small amount. Starting small isn't a limitation, it's a strategy. Investing small amounts allows you to learn faster and make mistakes without putting your financial future at risk. When you start with a modest sum, each decision carries less pressure, giving you the freedom to experiment, analyze, and understand how the stock market works. Every trade, every fluctuation, every gain or loss becomes a lesson. These early experiences are far more valuable than any amount of theory because they teach you how to react in real situations. Think about it. Investing 50 or 100 might not make you rich immediately, but it gives you exposure to the market, and exposure is how you grow. You learn about trends, stock behavior, and risk management. You discover how your emotions can influence your decisions. You start to understand what patience really means and how discipline compounds into profits over time. Starting small is like training wheels on a bike. You'll fall a few times, but eventually you ride with confidence. Starting small also teaches consistency. When you commit to investing even modest amounts regularly, you're building a routine that will serve you for life. The habit of contributing to your portfolio daily, weekly, or monthly is more important than the size of your investment. Over time, these small contributions add up significantly. What seems like an insignificant amount today can grow into a substantial sum over months and years, especially when combined with compounding returns. Another advantage of starting small is risk management. Large investments can create stress and lead to emotional decisions. Beginners often panic when the market drops, selling at the wrong time and losing potential gains. Small investments reduce this emotional pressure, allowing you to stay calm, observe patterns, and learn the discipline required to succeed in the long term. Starting small also forces you to focus on learning rather than just making money. Beginners often want quick wins, chasing trends or hot stocks, but those strategies usually end in disappointment. By starting modestly, you prioritize skill building, research, and understanding the market. You develop the mindset of an investor, not a gambler. Over time, this mindset will help you scale your investments intelligently, turning small beginnings into serious wealth. Finally, starting small today beats waiting for the perfect moment or the perfect amount. Many beginners delay investing because they think they need thousands of dollars up front. But every day you wait is a lost opportunity to learn, grow, and benefit from compounding. The earlier you start, the more time you give your investments to grow, and the more experience you gain to make smarter decisions in the future. The key takeaway is simply don't let fear or the illusion of needing a large sum stop you. Start small, be consistent, and focus on learning. Your first investment doesn't have to be huge. It just has to happen. Every small step you take now builds the foundation for larger gains tomorrow. Habits, experience, and knowledge compound just like your investments. In the end, the journey to making real money from stocks begins with a single, small action. Start small, learn fast, make mistakes, adjust, grow. And over time, those small beginnings can lead to extraordinary results that far exceed what you imagined possible. One of the biggest misconceptions about stock investing is that you have to perfectly time the market. Many beginners think the key to success is buying at the absolute bottom and selling at the absolute top. The truth is far simpler and far more reliable. Consistency beats timing every single time. The most successful investors don't try to predict the market's highs and lows. They focus on steady, disciplined action week after week, month after month. Consistency creates momentum. Even modest, regular investments accumulate over time and benefit from compounding. For example, investing a set amount every week or month, regardless of market conditions, ensures that you are always building your portfolio. When prices are low, your money buys more shares. When prices are high, it buys fewer. Over time, this strategy smooths out the natural ups and downs of the market, preventing the need to guess and reducing the risk of major losses from emotional decisions. Think about it like a treadmill. You don't sprint for 5 minutes and expect to get in shape. You run consistently over weeks, months, and years, and your body gradually transforms. The same principle applies to investing. Regular contributions, no matter how small, create a compounding effect that grows your wealth steadily. Skipping weeks or months because you're waiting for a better time may feel harmless, but it interrupts the process, and every missed contribution is lost growth you can't recover. Consistency also develops discipline, which is one of the most important skills in investing. Markets are volatile, headlines scream crisis, prices rise and fall dramatically. Without a consistent approach, beginners are tempted to react emotionally, selling in fear or buying in greed. By following a consistent strategy, you remove emotion from your decisions. You know that each contribution is part of a long-term plan, and that plan doesn't change based on daily market fluctuations. Another critical benefit of consistency is the confidence it builds. As you invest regularly, you learn how the market behaves over time. You experience small gains, small losses, and everything in between. These experiences teach you patience, resilience, and the value of sticking to a plan. You stop obsessing over short-term movements and focus on the bigger picture, your long-term financial growth. Consistency doesn't just apply to investing money, it also applies to learning. Consistently educating yourself about the stock market, analyzing your investments, and refining your strategies compounds just like money does. A beginner who spends a few minutes each day studying market trends or reading about successful companies will gradually become a knowledgeable investor. Over time, that knowledge amplifies the returns from your consistent investments. It's also important to understand that consistency over time often outperforms trying to time the market. Even if you occasionally buy when prices are high, your long-term plan compensates for it. The market tends to rise over time, and regular contributions ensure that you are always positioned to benefit from growth. The people who obsess over timing often miss opportunities because they are frozen by indecision or fear. The key takeaway is simple focus on what you can control. You can't predict every market fluctuation, but you can commit to consistent investing. You can stick to your plan, reinvest profits, and allow compounding to work its magic. Time and consistency are far more powerful than luck or guesswork. In the end, the path to building significant wealth in the stock market isn't about hitting perfect highs or lows. It's about showing up, investing regularly, and staying disciplined week after week, month after month. Consistency beats timing every time, and over the long run, it's the strategy that transforms small contributions into life-changing results. Investing isn't just about putting money into stocks, it's about putting money into the right stocks. That's where knowledge and research come in. Without understanding the companies you invest in, the markets you participate in, or the risks involved, even consistent investments can fail to reach their full potential. Knowledge is the multiplier that turns small contributions into serious returns, and research is the tool that allows you to invest wisely. The first step in gaining knowledge is understanding the companies you are investing in. Look beyond stock prices and headlines. Learn about their business models, their products or services, their competition, and their long-term growth potential. A company with strong fundamentals, solid management, and a clear vision is far more likely to grow over time than one that relies on hype or speculation. Research allows you to identify these opportunities before the market fully recognizes them, giving you an advantage. Next, knowledge helps you understand market trends and economic conditions. Stocks don't exist in isolation. They are influenced by global events, government policies, interest rates, and consumer behavior. By keeping up with these factors, you can make informed decisions instead of reacting impulsively to short-term volatility. For example, during a market downturn, understanding the underlying economic strength of a company can help you stay invested rather than panic sell. Knowledge transforms uncertainty into strategic action. Research also teaches risk management. Not all investments are equal, and some carry more risk than others. By analyzing past performance, understanding financial statements, and evaluating industry trends, you can identify which investments align with your risk tolerance. Knowledge allows you to diversify intelligently, reducing the likelihood that a single loss will derail your portfolio. 8. Beginners who neglect research often fall prey to hype or speculation, losing money unnecessarily. Knowledge protects your capital while enhancing your potential for growth. Another critical aspect is learning from experience. Every investment you make, whether successful or not, is a lesson. Knowledge comes not only from books or articles, but also from observing the outcomes of your own decisions. Over time, patterns become clear, mistakes become fewer, and your strategy becomes sharper. Researching before making a move accelerates this learning curve. By combining education with practical experience, your small investments can grow more efficiently. Knowledge also improves your confidence. Beginners often hesitate to invest or react emotionally because they feel uncertain. Understanding the companies you own, the trends driving the market, and the rationale behind your decisions builds confidence. You're no longer guessing. You're making calculated moves based on evidence and analysis. This confidence allows you to stay the course, even when markets fluctuate, which is essential for long-term success. Finally, knowledge compounds like money. The more you learn, the better your decisions become and the higher your potential returns. One small, consistent investment can multiply several times over when paired with the right understanding of the market. Knowledge turns ordinary contributions into extraordinary results. Even a $5 daily investment backed by research and strategy can grow into significant wealth over time. 8. The key takeaway is simple. Don't treat investing as gambling. Treat it as a skill to develop. Invest in your knowledge as much as in your portfolio. Study, research, analyze, and learn continuously. Every bit of understanding you gain amplifies the returns on your investments, reduces unnecessary risk, and positions you for long-term success. In the end, knowledge and research are the levers that turn small daily investments into meaningful wealth. Without them, even consistent investing may underperform. With them, you transform ordinary actions into extraordinary outcomes, gaining not just financial returns, but the skills and confidence to navigate the stock market with clarity and control. One of the most overlooked skills in investing isn't technical analysis, financial formulas, or market timing. It's emotional control. The stock market is unpredictable, and its fluctuations are inevitable. Prices rise and fall every day, and headlines scream fear or hype at every turn. Beginners often make one critical mistake. They let their emotions dictate their decisions. Fear, greed, and impatience can turn a well-thought-out strategy into costly mistakes. Emotional control, however, is the tool that separates successful investors from those who struggle. Fear is one of the most common enemies of investing. When the market drops, beginners panic. They see a loss and immediately want to sell, thinking it's better to cut their losses. But selling in fear locks in losses instead of giving the investment time to recover. Emotional control allows you to pause, analyze the situation, and act rationally. Understanding that market dips are normal and temporary helps you resist panic. Those who maintain calm during downturns often come out ahead because they stay invested when others flee. Greed is another powerful emotion that can sabotage even experienced investors. When prices surge, beginners are tempted to buy at the peak, hoping for quick profits. This can lead to overpaying for an asset and increases the risk of losses when the market corrects. Emotional control teaches discipline, knowing when to act and when to wait. It allows you to stick to your strategy instead of chasing trends, ensuring your investments grow steadily rather than swinging wildly. Patience is closely tied to emotional control. Investing is a long-term game. Even the best strategies require time to bear fruit. Beginners often expect immediate results and make impulsive decisions when they don't see quick gains. Emotional control helps you stay focused on the long-term vision, ignoring short-term noise and trusting in the power of consistent investing. It reminds you that real wealth is built gradually, not overnight. Another reason emotional control is critical is that it allows you to make logical, data-driven decisions. When emotions take over, you may ignore research, bypass risk management, or follow the crowd. But disciplined investors rely on knowledge and analysis rather than gut reactions. Emotional control lets you evaluate opportunities objectively, increasing the likelihood of profitable outcomes. It turns the stock market from a source of stress into a tool for building wealth. Emotional control also protects you from burnout and anxiety. Markets are unpredictable, and watching prices fluctuate can be nerve-wracking. Without emotional discipline, 8, beginners can become stressed. Second, guess themselves or abandon their plans altogether. By cultivating calmness and rational thinking, you maintain focus, reduce stress, 8, and make better decisions under pressure. Emotional control isn't just about avoiding mistakes. It's about creating a mindset that supports consistent, confident action. Finally, emotional control compounds over time, just like money. Each time you resist panic selling, each time you stay calm during a volatile market, you strengthen your ability to handle future challenges. You learn to detach from short-term swings, focus on long-term growth, and make decisions aligned with your goals. Over months and years, this discipline multiplies the effectiveness of your investments, turning modest daily contributions into substantial returns. The key takeaway is simple: emotional control is more valuable than any stock tip, any trend, or any strategy. Fear, greed, and impatience are the biggest threats to beginners, while discipline, patience, and rational decision making are the most powerful tools. By mastering your emotions, you protect your investments, maximize returns, and create a mindset that enables long-term success. In the end, knowledge and strategy alone aren't enough. Emotional control is what allows consistent action, disciplined investing, and patience to truly work. It transforms the uncertainty of the market into opportunity and turns everyday investors into confident wealth builders. If you want to grow $5 a day investments, or any amount, into meaningful financial results, mastering your emotions isn't optional, it's essential.